Okay. Hello, it's Stephen Goakes here from Natgen Group. I'm coming to you today to talk about the forms of income that you can expect from Natgen Investment Trusts. Fairly regularly we get asked by investors how our investments compare with other types of investment, particularly bank deposits, which is topical at the moment because we're in an environment where bank deposit rates have increased fairly substantially over the last 12 months, and also, of course, so has inflation. The two go hand in hand. So a Natgen investment trust in a higher inflation environment, how does that compare with other investments? So what I thought I'd do is take an investment of $100,000 and see how it compares in a cash, putting it in a cash deposit as opposed to having it in a Natgen investment trust. And that will give you an idea of the three types of income you can expect from Natgen trusts. So let's say in year one of this term you will have your income, and I'm going to say the cash deposit rate is currently you can get up to about 4.9% for a 5-year fixed term. Your money is locked away for 5 years. And in a Natgen investment trust, you'll be looking at somewhere around 8% or thereabouts, again for a five-year typical term. And again, your money is tied up for that time. So the income that you'll get during that time for the cash deposit on $100,000 will be $4,900. And on the Natgen Investment Trust, you'll expect to receive $8,000 for that first year. The next thing that comes into play is taxation. So for a cash deposit, you'll pay tax on the entirety of that. And to make the sums a little bit easier, I'm going to use 50% as the tax rate at the moment. I know it's 47 plus or minus Medicare levies, etc., but I'm going to say 50% just to make the maths a bit easier. So 50% of your $4,900 will be $2,450 tax to pay, leaving you in your hand with $2,450. In a Natgen investment trust, you'll find that usually the first 3 to 4 years are tax sheltered. So in this case, there'll be no tax to pay in that first year. So your cash in hand will be the full $8,000. So the important thing to remember in these times is inflation. So let's look how inflation affects the returns. So inflation, I'm going to say, is running at around 7%. It's currently a little bit higher than that. It's been a little bit lower. So 7%. So the purchasing power of your $100,000, where CPI is running at 7%, reduces by $7,000 per annum. So that means that you take your cash of $2,450 and take $7,000 off that, you'll actually end up, you're down $4,550 in the negative for the year, even having made 4.9% per annum in the bank. Inflation is obviously the same for the same $100,000 here. So in this case, you'd be ahead by about $1,000 for the year. So that's just a very simple example using made-up rates, but pretty close for those issues. I guess what this means is that you've got your income return, your income number, which is important to look at to compare things. But when you take taxation into account, it gets quite different. So one thing to bear in mind also, I'll say here, is that when I've said zero tax here and it's tax sheltered, that taxation that you don't pay in the years going forward actually does come off the cost base of your asset. So what you're actually doing is you're turning your capital profits, income profits into capital profits. And the advantage of that is that the taxation rate on capital gains is 50% less than it is on income gains. So First of all, you're saving tax because you're not having to pay it for years into the future. In this case, the taxation on the capital profit would be in the 5 to 6 year time frame. But also, you're only paying half as much tax on that when it comes through because of the reduced rate payable on capital gains. The next thing, so what we've got is two things. We've got income return, and we've got taxation advantages. Each of those impact both the total value of the investment and also the cash available in the early years. The third thing, which we don't talk about very much, is capital profit or capital gains over time. Now, this is something that you won't get at all in a cash deposit. If you put $100,000 in the bank, you are going to get $100,000 back. Pretty simple. One of the advantages of this, of course, is that there's a government guarantee of that fact. But with commercial property, well-managed, well-located commercial property, you can expect the value of that property to increase over time above and beyond just the income. And to give you an idea of that, I have a chart over here which I think will be interesting. This is a chart produced by a global commercial property research company, which looks at the rolling annual returns of Australian commercial property between 1986 and 2022, and of course this chart will continue. The blue line is the total return per annum through all that time. So as you can see, the total return expected on commercial property over time has typically been around 12 to 15% if you take an average through that line. That total return is made up of two aspects. The first of all is income. So the yellow bars are the quarterly income from commercial property over that very long period of time. And as you can see, it's been very consistent over that time. There hasn't been much change in income rates over time. What has varied is the green lines, which are the capital gains or capital losses during that time. So the late 80s, a time of significant capital gain in commercial property. The early 90s, a lot of that was cancelled out and brought us back sort of to the average. But between the mid-90s and 2008, there's been a fairly consistent capital gain, capital profit each year, or each quarter in fact, through that entire time. That only came to an end when the global financial crisis gave us a year and a half of negative returns, but then capital profits came back into the market for the next basically 10 years, and it was only with the pandemic that we saw a short reduction in capital profits over time. But as you can see, a lot of this is very consistent over long periods of time. So this capital profit is the thing that we don't provide guidance on in Natgen Investment Trusts. But what you do know is that our trusts typically are a 5 to 6 year time frame. So if you take any 5 to 6 year time frame over any of these periods, even through the worst of it, you should have an average out of a level of capital profit through there. As I said, it's something that changes from year to year, so we do not forecast it, but it's something that you should be able to basically glean from this graph. Even if you came in through here to the very for 5 to 6 years to the very worst of 2009-10, you'd see that the amount of area of capital gain is significantly more than the capital loss in those couple of years, and hence over time it tends to be positive. So that's the third level of return that you get from a Natgen Investment Trust or any commercial property for that matter. So basically, just to recap, a cash deposit at 4.9% in an inflationary environment will give you a negative real return. A Natgen Investment Trust higher return, including a tax benefit, will put you in a better position in a high inflation environment, and none of that takes into account capital profit, which does not exist in cash deposits. I hope that's helped in giving a bit of an understanding of how this works and what you can expect with Natgen Investment Trusts. Thanks for your time.